appropriate, so that it will help you to understand how traders perform in the market. So I am conducting my first poll for you. There you have to answer me. So I am asking you how successful you are in choosing a best stock. So this is my first poll. So post that we will be starting. You start voting on that. How many people or how many of you are thinking that how successful you are in choosing a best stock out of a basket of stock? Basket of stock, whenever I am telling, if I am telling you out of private banking sector, out of 5 stocks, you give me a best stock to invest for 1 month, 2 months or 3 months. How best you are in choosing this? So this is my first question. All of you are getting the view of this thing. Now 209 people are expected. Please give your views. Please give your views. So here only 2% people are saying that we are good at this, choosing the best stock. Very good at this. 37% or 36% people are saying that good. 56% people are saying that they are poor in choosing a best stock. Out of 214 people, 82% of people have voted for this, and 5% they are saying that bad. Our choice of stock is very, very bad. Only 36% says that okay, we are good at this. 2% are saying that we are very good. 56% says that poor, 5% very bad. So this is the experience of the trader. Out of 219 people, 85% of people voted in this survey and they are giving this. So I am closing this survey now and I will move to the topic. So this objective of this session is to give you a best method by means of which you can make a uniform choice or best choice for investment. So whenever we invest in a stock, what we used to look in that particular stock? What we used to look into the stock? Whether the stock should be a much talked about stock in the trader's domain, or whether that stock is fundamentally sound, whether that stock is a very affectionated stock by the stock trader. Nothing, all this, none of these things we expect in a stock. Our expectation from a stock is, or our expectation from our investment is, wherever we are putting our money, it should give us good return. In terms of return, it should reward us nicely. That should be our objective. Nobody invests in a stock with the objective to lose the money. Everyone having that expectation to gain from the investment. So that is our objective. Best practice which is being followed by most of your fund managers. I again repeat, the best practice which is followed by most of our fund managers, mutual fund industry or the FIs are, they are dependent on some of the key ratios, and these ratios are known as the golden ratios. What are those ratios? One of this ratio is Jensen's alpha, J alpha. Second is Sharpe ratio. Third is Trenor's ratio. So this Jensen's alpha says, if you compare between two stock, which is A and B, if you compare between these two stocks, and if you find out the Jensen's alpha, Sharpe ratio and Trenor ratio, using this formula, Jensen's alpha takes that average return what the stock A has been given minus interest rate plus stocks beta. But how beta means how this A and B are related. Means if A is moving by 1%, how much B will give, that is your beta. And average return the stock B has given minus interest rate. So this is what the Jensen's alpha says. Similar way, we have the Sharpe ratio, which gives based on the volatility we estimate this ratio. Similar way, we have a Treynor ratio based on the beta we estimate this ratio. So these three ratios are very important for choosing a stock. So after computing these three ratio, the stock which is having lower Jensen's alpha, lower Sharpe ratio and lower Treynor ratio is considered to be a investment worthy stock as compared to the other one. I repeat again, the stock which is having lower Jensen's alpha, lower Sharpe ratio, lower Treynor ratio as compared to its peer is considered to be a best stock for investment. So same way, if we can go on formulating these combinations and if we go on calculating this value and conclude these things, then we will get the best stock. Calculation part, I will take in the Excel sheet and I will also share that Excel sheet with you. So now the next question here, what is the alpha? Another ratio is called as your alpha. So alpha is considered to be a ratio. If it is positive, then a stock is overpriced. If it is negative, then the stock is considered as underpriced. So alpha of a stock, whenever you compare between A and B and compute their alpha, if alpha of a stock is positive, then it is overpriced. If the alpha is negative, then it is underpriced. So beta, which you require for the calculation of one of this ratio, which is your Treynor ratio, which requires the beta to be used for helping to calculate this Treynor ratio. What does this beta mean? And it is a very fantastic parameter beta. On the last part of this 1 month series of education, you will be learning beta decoupling technique also. The beta of a stock, if it is negative, then it says that both the stocks will move in the opposite direction. So here you are using two instruments to compute this beta, compute alpha, compute this Jensen's alpha, compute all these things. So two stocks you are taking. If beta is positive, then both will move in the same direction. If beta is 0, then they do not have any relationship. So this is what this meaning of this relationship is. Now coming back to our objective, investment objective. So whenever we talk about the investment objective in the short term, so to my parameter, the short term objective is 1 month, medium term objective will be 3 months and long term objective will be 6 to 12 months. Though many of the TV anchors never say any scale for your short term, medium term and long term, though many of the analysts, for them the long term objective is 5 to 10 years, but for me it makes the sense. Short term objective is 1 month, medium term objective 3 months, long term is 6 to 12 months. So while forming this or utilizing this ratio for your benefit, you must fix your objective. What is the objective for which you are going to choose a stock for your investment? Based on that only you need to compute all your parameters. And whenever we talk about the financial parameters like your PE ratio, like your EPS, earning per share, all these terminologies are not a correct yardstick for calculating the, it is not the correct yardstick for calculating the financial performance. Just 1 minute. Long term objective we have fixed. Now what is the next move we should proceed? So The next part of our thing is, as an investor, we know the stock which is available at a cheaper price we need to buy, and the stock which is costlier we must avoid that stock in investing. So that always we want for this. So you need to choose a best stock out of 3 out of 5 means what is your objective? Your objective is I must buy a stock which is available at a cheaper price as compared to the other stock, and I must not buy a stock which is costlier at that particular time. So now if I say you that between SBI, HDFC Bank and ICICI Bank, which is the best stock to invest? If this is the question I ask all of you, then your answer will be out of these 3 which is cheaper. So how to find out? So out of these 3 things which is cheaper, in that stock I am going to invest. That is my objective. However, how to find out? So I'll be taking the help of all these ratios to help me in finding out this. So I'll just take one Excel example to demonstrate that. We'll investigate, find out the best stock, and based on that we'll be finding out the investment objective. So here my investment objective is short term, it is for 1 month. So I have taken the July State Bank of India and HDFC Bank, and their historic prices I have taken. Historically, what are the prices they have given? So this historic prices you can download from the NSE site. So from there you can take the last traded price. So this is the last traded price, not the closing price, not the average price you will take. You will take the last traded price. Once you take the last traded price and start doing the calculation on this, 1st July to 31st July I have taken, then little bit of modification I have on the rules I have added in that. What is that rule? The first rule what I have put in this particular method is, use the stock which is having higher volatility as parameter X. The stock which is having the lower volatility should be taken as Y. Then only you can do your calculations. So I have taken SBI last traded prices. Every day what is the return it has given? 1st July I have started. So previously I am saying that nothing is there. So every day basis what is the return it has given? I have just calculated that return. Similar way HDFC Bank. What is the percentage of return it has given? So then I have calculated the average return what the stock X or SBI has given, average return what the HDFC Bank has given. Then I have calculated their volatility. For calculating the volatility, I have utilized the logarithmic formula. So here you have to use the log of current price divided by the previous price, and you have to take their average. And same way you have to take the square logarithmic value also and take their average. Once you take these averages of the logarithmic value and square logarithmic value and calculate their volatility, so we are getting here HDFC Bank is having a volatility of 19%, and State Bank of India is having a volatility of 30.74%. Henceforth, we have taken State Bank of India as X and HDFC Bank as Y. Then we require to calculate its beta, we require to calculate its alpha, we require to calculate Jensen's alpha, Sharpe ratio and planar ratio. Then also I have added one parameter called correlation. So all these formulas as it is available in the Excel, just I have taken that. So alpha, once I have calculated, this alpha is standing for the second Y, means it is for the HDFC Bank. So alpha says that it is positive. HDFC Bank's alpha is positive. That means the HDFC Bank is costlier as compared to the SBI. Similar way, we have found out the Jensen's alpha for SBI and Jensen's alpha for HDFC Bank, Sharpe ratio also, Treynor ratio also. So alpha, once you have found out for HDFC, no need to find out for the State Bank of India because this one parameter itself is sufficient. However, for Jensen's alpha, Sharpe ratio and Treynor ratio, you need to calculate. Once we calculate these things, these values if you see, Jensen's alpha for SBI is negative and for HDFC positive. So definitely SBI is cheaper and HDFC's bank is costlier. Sharpe ratio also given same, though both are positive. The Sharpe ratio value for SBI is lesser. Treynor ratio's value for SBI also lesser. So all these parameters says that SBI is cheaper and HDFC Bank is costlier. Move to the next part. I have taken SBI and ICICI Bank. Their volatility says SBI's volatility is 30.74, ICICI is 30.28 in annual terms. So SBI I have taken as X, ICICI Bank I have taken as Y. So by this process also I have concluded that ICICI is cheaper and SBI is costly. In both, so here the alpha is negative for ICICI Bank, so alpha also says that ICICI Bank is cheaper. Third, because in these three stocks I am taking, so three combinations I can form. One is with first combination I have formed with SBI and our HDFC. Second combination I have formed with SBI and ICICI. Third combination I have formed with ICICI and HDFC. So based on their volatility, stock which is having higher volatility I have kept it in X. Stock which is having lower volatility I have taken is a Y. So based on these parameters I have calculated their alpha, Jensen's alpha, Sharpe ratio, Treynor ratio. So stock which is having higher Jensen's alpha as compared to the other or its peer company must be costlier as compared to its peer company. So stock which is having lower Jensen's alpha, lower Sharpe ratio, lower Treynor ratio, lower alpha is considered as cheaper. Stock which is having higher Jensen's alpha, higher Sharpe ratio, higher Treynor ratio is known as costlier. So based on this, we have concluded the following. So these three analysis of July, it says, yes, ICICI is the cheaper stock. Next hierarchy goes to SBI. Third goes to HDFC. So whenever we talk about the cheaper stock, it has two definitions. The first definition of cheapest stock is ICICI is the cheapest among these three. Means if any correction happens, ICICI must correct less. Or if the price of these three stocks is going to fall, then ICICI must fall less as compared to others. Whenever there is a growth or price rise happens, then the cheapest stock must give good return, better return as compared to the others. So this is for ICICI cheapest, SBI next, HDFC next. When we have taken this last July 31st prices of equity segment, we are not talking about future. Equity segment prices was 300.8 to 69.3 and 4 times 1.2 is HDFC. And August whenever we have ended, August end, this is the prices 278, 247 and 1025. If I compare all these three, then the cheapest stock which I have identified has corrected less as compared to the others. So this is validated, taken for the month of July, validated for the August, because once you have invested, this has corrected less. So the stock which is the cheaper stock has corrected less as compared to the others. Now move to the next part. We have taken for August same way in the same stocks, 3rd August to 31st August. We have taken these prices 3rd August to 31st August, and same way we have taken and we have concluded SBI is in the month of August. It is SBI is coming the cheapest, ICICI is coming the next, and HDFC Bank is coming the least. Means HDFC is costlier as compared to ICICI, ICICI is costlier as compared to the SBI. So now in the ongoing September month is going on. In the September month till 23rd, till 23rd of this 24th of September, the performance is 3.23 negative. SBI, ICICI corrected 5.59, HDFC is positive, and in between there is a news which has propelled this HDFC. It is not the fundamental. In between couple of good news which has propelled this, and it is not because of its fundamental move. Same way, now if I can say that I am in the mid of the September, 24th September. So whether I lost the opportunity? No. Wherever you are, from that point also you can make the calculation. So by taking till 24th September data, if I can say here SBI and HDFC, SBI is the cheaper. And again, if I will say that ICICI and SBI, ICICI is the cheapest. And here ICICI will definitely come. So now current scenario, ICICI is the cheaper stock. Second goes to SBI. Third goes to HDFC Bank. And you can little refine this result also. Because one parameter which we have used here, but we have not taken into confidence for deriving our decision, that is correlation. Whenever you are forming this kind of comparisons, you must see that correlation should remain above 0.62 and below 0.75. That is the ideal zone. If the correlation is staying, then this analysis will give you maximum probability of success to the tune of more than 90%. So here the correlation, though it is saying SBI is cheaper, HDFC is costlier, but correlation is 0.53. Second analysis, whenever we are doing here, so here though we are getting this thing, it is a perfect correlation. So ICICI and SBI is having a perfect correlation which is well within the band of 0.61 to 0.75, and correlation never goes above 1. It is 0 to 1. So third, whenever we are coming between the ICICI and HDFC, correlation is very low. So these two analysis we may discard. We may say that the combination of ICICI and SBI is perfect. Now we have to select a company to simulate with ICICI Bank and SBI, which is having a correlation in the same zone of 0.61 to 0.75. So if this correlation is in this band and the 3 stocks or 5 stocks, whatever you are choosing for your comparison, all these stocks are giving you a cheapest stock followed with a cheaper stock and followed with a costlier stock, then you will get maximum benefit out of your investment. So this is This is the way you should do. And this is not only help you for initiating a good investment decision, this also helps you to form a pair trade. This not only helps you to derive a investment decision, this also helps you to form a pair trade. So those who are the Smart Finance clients, those who are already bought our software stocks, they will be knowing that we have a pair trade software using the same ratio principle we have developed, which you can utilize for intraday analysis and positional analysis. And this product comes in our integrated tool nowadays, the Smart IT software what we have launched recently. This pair trade is also a part of that particular application. So if I can remove this SBI and put any private sector bank along with ICICI and HDFC, say IndusInd Bank or Yes Bank, then my analysis of choosing a best stock in the private banking space will be more refined. Same way, if I'll take all public sector banks, 3 or 5 public sector banks and choose the best among them, then my investment objective will be more refined. So many things you can do with this particular method. I'll be sharing the Excel sheet with you. You can download and utilize these things for your benefit. And if you have any query also, you can ask me now. On the alpha value, multiply with 10. You can say if HDFC and this particular worksheet, if you can see ICICI and HDFC Bank, I am comparing. Alpha is 0.33, means ICICI Bank is 3.3% cheaper as compared to the HDFC Bank. That is how you translate. Smart Finance having 10 products, and it is all are educational and software related products, and all products, educational products, comes with a printed book, 3 DVDs, and software products also accompany with the user manual, books and DVDs. We never hide any concept. The concept what we have programmed, same concept we used to is written in the book. So all these things what you will experience during this program are being already written in our educational materials. Those who used to purchase this particular product, those who wants to purchase this product, you can contact our sales number here, it is being given. And besides that we have those all-in-one tool wherein you will get pair trading. This is same Jensen's alpha, Sharpe ratio and other things we have used and formulated this one. And you will get all intraday positional software, which is just recently we have launched this Smart IT software. Those buyers, those who have been using our integrated tool software earlier, we have given them the free access to this new tool. So, and this product also available in the demo mode. So 7 days of unrestricted access to this software is being given. You can also download, utilize it for 7 days. Then if you are satisfied, you can go with this tool. This is about the intraday and this thing. And soon we will be adding a feature for choosing the best stock out of a combination of 3 or 5 stocks in this same tool. Using the same ratios for investors, we do not have a software currently, but in the same software, we are going to facilitate this feature of choosing a best stock in coming days. And those who are already using, they will be intimated for upgrading to that facility. Stock which is having negative alpha is cheaper as compared to its positive alpha. So while reading the alpha, if the alpha of A and B company is 0.33, which is visible here, if the alpha of A and B company or ICICI and HDFC is 0.33 positive, then I will say that HDFC Bank at this particular scenario is 3.3% costlier as compared to the ICICI Bank. Johnson's alpha, Sharpe ratio, Treynor ratio will guide you based on their value. If Johnson's alpha is lower for ICICI Bank, then ICICI Bank is cheaper. If Sharpe ratio is lower then for ICICI Bank, then ICICI Bank is cheaper. If Treynor ratio is lower for the ICICI Bank, then ICICI Bank is cheaper. When coming to the correlation, that is very important parameter. Whenever you are forming this pair, look into the factor of correlation from 0.62, which is a stabilizing zone of correlation. Correlation means how both the stocks are related between each other. What is the bondness? What is the strong affection between them? So that is correlation. If the correlation between 0.6 to 0.75, then this is a very ideal correlation for your investment choice. Above 75, you can say it is an unstable correlation. Below 0.6 also, you can say it is an unstable correlation. So while forming choose the stocks which is having a correlation. First make a choice of the stocks which is having a correlation between 0.6 to 0.75. That through simulation process you have to manually do. This is not a software, this is a plain Excel sheet only. Then you look into alpha, look into Johnson's alpha, Sharpe ratio, Treynor ratio, and derive your investment decision. And while choosing both the stocks for comparison, or one should be X and other should be Y, so the stock which you are going to make it X must have higher volatility as compared to the stock which is you are treating as Y. So that is also one of the finest rule you need to understand.